Hello everyone, welcome back to Rise Finance. The markets have been on a stupendous run since middle of the month when the Fed announced the rate hikes. In the last 2 weeks, we can see the market rising almost 11%, which is amazing. When you look at the year-to-date charts, the S&P 500 was down 13% till March 14, which meant it was in a correction territory. But from March 14 onwards, it has risen by almost 11%. So it is trying to gain ground every day. We don't know how long this rally will last because we still have the Russia-Ukraine war situation that is not yet resolved, and also the supply chain issues which have not been put to rest completely. Also, the inflation is notching record highs every month and has the potential to knock the rails off this rally at any moment. But we as dividend investors will keep looking for bargains in the market and keep investing wisely. In this video, we will go over a few such stocks which are still very undervalued, have good fundamentals, and hence may offer good growth in the coming future. Let's check it out. If you are new here, consider subscribing and hitting that bell so that you don't miss a single video packed with valuable information just like this one and help grow this young channel. Let us take a look at the dividend picks that were for March 2022, which I had chosen a month ago. We had Leggett& Platt, Medtronics, T. Price, Air Products and Chemicals, and UGI Corp. In the last 1 month, we can see Medtronics, T. Price, and Air Products gaining almost 5%. And in fact, they have been a good momentum even the last 5 days. Leggett& Platt and UGI have yet to recover. In the last 1 month, they have gone down further. When we look at the dividends of these five stocks, we can see that the trailing 12-month yield and also the forward yield are much higher than the 4-year average yield, which means they are fairly valued at this time, which means they are cheaper at this moment compared to how they were previously. So these still offer a good entry point that one can make use of. Among Leggett& Platt and UGI, which have dipped further in the last month, I'm no longer considering investing any more money into Leggett& Platt. The reason being, Leggett& Platt was removed from the dividend aristocrats list, which is a group of companies that have paid consecutive dividends for the last 25 years. But Leggett& Platt failed to raise its dividend last year, so it was removed from that list. So we can see here the dividend growth has only been for last 1 year. Before that, it was paying for almost 40 years. The 5-year growth rate has fallen to 4.32%. It has a relatively higher payout ratio of almost 60%. So I'll not be selling out of my position in Leggett& Platt, but will not be contributing anymore. But UGI, which dipped almost 7.5% in the month of March, makes it to my April's dividend picks. To give a brief overview of UGI, it's a natural gas and electric power distribution company. It owns AmeriGas, which is the largest propane company in the United States, along with a few other key players in the industry. It has a market cap of $7.5 billion and provides a very good yield of 3.88% at a very good PE of 12.9. Year to date, UGI has dropped almost 20%. In the last 1 year, almost 12%. Dividends wise, it has been growing dividends for the last 18 years at a growth rate of 7.75% for the last 5 years and a good payout ratio of just over 50%. As per Tracker Dividends, it has a 95 dividend score for UGI with all the metrics that it considers to arrive this score being very good. Tracker Dividends calculates UGI to be almost 36% undervalued, but I really don't go by their way of calculations. As per my own calculations, using the past yield, the current yield, and the future forecast, I see UGI to be at a 26% discount right now and providing 17% average annual growth over the next 5 years. UGI is a very good utility company to hold in one's portfolio. It provides a yield which is almost 3 times the market value, has been growing dividends consistently for the last many years, and the growth rate is also on par with the inflation currently. So one may consider it. My second dividend pick for April 2022 is Huntington Ingalls Industries, which is the largest military shipbuilding company in the United States and is also one of the providers of professional services to partners in the government and industries. It is a very key manufacturer of naval ships for the US government. Year to date, Huntington Ingalls has given almost 9% returns. In the last 1 year, though, it has fallen almost 3%. It has a market cap of $8.25 billion and gives a yield of 2.36% with a PE of almost 13. From the dividends perspective, it has been growing its dividends for the last 9 years at a very good growth rate of 16% for the last 5 years. It is more than double the inflation that we have currently of 7.95%. The payout ratio is very respectable of 34%. Tracker Dividends gives Huntington Ingalls a dividend score of 76. We can see here the dividend per share increasing very nicely in an upward trend. Tracker Dividends considers Huntington Industries to be almost 7% undervalued, but per my own dividend calculations, I find it to be undervalued by 22% and giving an average annual growth of 21% over the next 5 years. Huntington Ingalls Industries is a very good industrial company to hold in one's portfolio. It gives a market beating yield. It's almost a monopoly in its industry of building ships for the Navy. The dividend scorecard looks good with the inflation beating growth. Overall, one should consider it for their portfolio. If you like this video so far, I would really appreciate if you could hit on that subscribe and like buttons so that YouTube can recommend this video to many more people out there. The third stock on my April dividend pick is Tractor Supply Company, ticker symbol TSCO. Tractor Supply Company is an American retail chain of stores that sells products for home improvement, agriculture, lawn and garden maintenance. It has been in existence for more than 80 years and has more than 2,000 stores in the country. Tractor Supply Company has a market cap of $26.2 billion and gives a yield of 1.58% and has a PE of 24.7. Year to date, Tractor Supply is down 1%, but over the last 1 year, it has given a return of almost 33%, and in the last 5 years, almost 241%. So these are good returns. When you look at the dividends, it has been growing its dividends for the last 11 years. The 5-year growth rate is amazing at almost 21%, which is almost like 3 times the current inflation. The payout ratio is very low at less than 25%. When you look at the financials of this company, they look great. The gross profit, as you can see here, is growing every year. Likewise, the operating income and also the net income. The dividends per share has been growing nicely upward. It has a healthy balance sheet with the cash flows. Tractor Dividends gives a Tractor Supply a dividend score of 80. You can also see here the upward trend in the dividends per share. We can see here recently Tractor Supply and Company raising its dividend by almost 77% and by 30% in the previous year. Tractor Dividend considers Tractor Supply and Company to be overvalued by like 0.3%. But as per my own dividend yield calculations, I find it to be undervalued by 23% and providing an average annual growth of 20% over the next 5 years. Overall, Tractor Supply and Company is a good stock to hold that provides yield that is more than the broader market, that grows at a very good pace. So it provides decent dividends and also a good appreciation at the same time, and one should consider it. The fourth stock on our April dividend pick is Goldman Sachs. Goldman Sachs is an investment banking company that provides financial services to corporations, financial institutions, governments, and individuals. Goldman Sachs has a market cap of $114 billion and provides a yield of 2.39%, and it has a PE of 8.64. Year to date, Goldman Sachs has fallen almost 14%. The last 1 year, it has given return of just over 4%. Last 5 years, almost 49%. It has been raising its dividends for the last 5 years with a very good 5-year growth rate of almost 23% and a very low payout ratio of just 11%. Looking at the financials of the company, the total revenues are growing in a nice upward trend, and the operating income is growing upwards. The dividend per share is also growing in a nice upward trend. Track Your Dividends gives Goldman Sachs a dividend score of 78. Track Your Dividends considers Goldman Sachs to be undervalued by almost 43%, but as per my own dividend calculations, I found Goldman Sachs to be undervalued by 26%, giving an average annual growth of 20% over the next 5 years. Overall, Goldman Sachs is a very good pick from the financial sector, offering a very good entry point at the moment. With it being down almost 14% year to date, it provides a good yield of almost 2.4%. That is growing at a very good rate. So one should consider it as part of their watch list or even add it to their portfolio. The fifth and final pick for our April dividend stocks is Jefferies. Jefferies is an American financial services company that provides investment banking and asset management services. It has a market cap of $7.8 billion, providing a good yield of 3.75% at a PE of 9.57. Year to date, Jefferies has fallen almost 16%. In the last 1 year, it has returned just over 10%. And the last 5 years, almost 28%. Seeking Alpha mentions Jefferies to be growing its dividend for the last 2 years, but I feel that is incorrect because if you look at the last 5 years history, you can see that it has been growing its dividends every year for the last 5 years now. The 5 year growth rate is though very good at almost 32%, with a very low payout ratio of just under 15%. The financials of the company also look good, with the total revenues growing upwards, also the operating income. Tracker dividend gives Jefferies a score of 69. Here we can see the dividends per share growing nicely upwards. And historically looking, it has been raising its dividends almost every other quarter in the last 2 years. Tracker dividends considers Jefferies to be undervalued by 66%, but as per my own dividend calculations, I found Jefferies to be undervalued by 31% and giving an average annual growth of 29% over the next 5 years. Overall, Jefferies is another very good pick from the financial sector that one should have it in their watch list and may also considering investing at the current entry point. So these are the 5 picks that I consider for April 2022 to be undervalued at the moment, and one should make use of this opportunity to invest. I'm not a financial planner, and everyone should do their own due diligence before investing their hard-earned money into the market. I hope you really liked this video today and got some valuable information from it. I'd appreciate if you could mention in the comment section which other companies or stocks or ideas you want me to cover, and I'll try my best to do. Thanks for watching. Until we meet in the next video, let's try as much as we can to be financially healthy. See ya. Bye.